uh, how we can use panel data in finance and economic equation. So I'm sure everyone, I'm not sure, but I think because you're coming from the computational and sciences faculty, um, I'm sure everyone already familiar with the time series data and also the panel data. So here I would like to show you about how we're using the panel data in finance and in economics. So for these 2 hours, I'm going to talk about the panel data. What is panel data? And the second one, how we are going to use the panel data in finance and also in economic. So panel data include observations on the same variables from the same cross-sectional sample from 2 or more different time periods. So panel data also known as longitudinal data. What it meant by longitudinal meant it involves several time, meaning that if we have a company and we use data for that company for several years. For example, like Maybank. I'm sure everyone, Maybank also have the branch in Indonesia. Maybank, let's say we use equity data, Maybank equity data for 10 years. And then we select another data for the bank, for example, CIMB Bank. So we have already 2 banks for 10 years. Since we have time, several years, which is from year 1 until year 10, and we also have more than one country or company, in this case is a bank. Therefore, it's called a longitudinal or panel data. It involves company and also involves time period. So another data, there are several large data on panel data. For example, in Malaysia, we have My Census and My Census data, Malaysia Household Panel Data Survey, Malaysia National Public Health Survey. So here, all these data involve an individual, and that individual will have several years of data, income data. For example, Balkis, and then Aminah, and then Ahmad. We have Balkis, Aminah, Ahmad. We have their income data, for example, income data for several years. Or we have their health data for several years. So that is also known as panel data. So panel data can actually help answer questions that cannot be answered with the time series or cross-sectional data sets. It can also increase sample size. Panel data also can increase sample size because it has several years, the time period, and also the country or the individual. And there are 4 different kinds of variables in panel data. One is differ between individuals, but not over time. It change over time, but are the same for all, but the same for all individuals at the same time. The third one, it vary over time and by individual. And the fourth one is trend variables. So in panel data, we have fixed effects and random effects. What does it mean by fixed effect models? The fixed effects model estimates the panel data by including enough dummy variables to allow each cross-sectional entity. So here we have TF. TF is meant for time fixed effects, and EF is the entity fixed effects. Entity, for example, like I mentioned just now, is the company or the individuals or the country. While time here depends on the period, whether it years, it quarter, month, days. So because it involves several entities and time effect, therefore it is known as panel data. So in the fixed effects, estimate panel data by including enough dummy variable to allow each cross-sectional entity and time period to have different intercept. So different intercept means that beta 0, it has a different beta 0. Under the fixed effect model, if we estimated model without accounting for the panel nature, the equation will look like this. Y, the dependent variable, YIT, I is the entity effect, and T is the time effect, equals to the beta 0, which is the constant, plus beta 1 XIT plus VT, where VT is actually the error term plus A. A is referred to the entity characteristics omitted, and ZT is the time characteristic omitted. So that is for the fixed effect model, where under the fixed effect models, including dummy variables, just now as I mentioned, EF for every entity, but one unobservable but unchanging entity effects are controlled. And then it also include dummy variables, TF for every period. And we can control for time fixed effects. So including this dummy transform into V, from V into E or the error term. And fixed effect models avoids bias due to variables that don't change over time or that change over time for all entities. So this is an example from a textbook AH Student Moon from Pearson. It shows that the fixed effect estimation on the cross-sectional model, MRD RTE, which is the number of murders per 100,000 people in the I state in 1990, and exact I is the number of execution in the I state in 1987 until 1989. So if we look at the graph here, example of fixed effects, we can see that in the single year cross-sectional model, the murder rate appears to increase with the execution. So this is an example of fixed effect estimation. So this is under the, if we include the panel data for the fixed effects, this is under pools, yeah? And this is under fixed effects. We include the time effects and also the individual effects. So here we can see that from the graph, in panel data model, the murder rate decreases with execution. So here, if we use the fixed effect model to estimate the panel data from 1990 to 1993, the murder rate is actually decreases with the number of execution. Unlike if you use the pools here, based on this one, based on this model, use the pool. In the single year cross-sectional, the murder rate appears to increase increases with the execution. Under panel data, we have random effects and fixed effects. So fixed effect model based on the assumptions that each cross-sectional unit has its own intercept. And the random effect model is based on the assumptions that the intercept for each cross-sectional units is drawn from a distribution that is centered around a mean intercept. So that is the main difference between fixed effects and random effects. The random effects model has several clear advantages over the fixed effect models. One is have many more degrees of freedom, and it can estimates can be generated for variables that are constant over time, such as gender or race. And under random effects model, it requires the omitted effects are uncorrelated with the independent variables. And how to decide which one to choose, whether fixed effects or random effects? We use Hausman test method to decide whether to analyze using fixed effects or random effects. So under Hausman test, it tests to see whether the regression coefficient under fixed effect and random effects are statistically different. And if they are different, fixed effect model is preferred. So kalau under H null, kalau masih using the Hausman method under H null, we say that the random effect will be used. If we reject H null, we say that we use the fixed effects. So based on this, based on the number of large scale, and it says that some same variables from the same cross-sectional sample from two or different time period. This is how it looks like. The entity, number 1, number 2, number 3. Year, it can be year 1, year 2, year 3. For example, entity is country. 1, country means for Malaysia. 2, for Indonesia. 3 is for Singapore. So based on, we have several countries and several years. This is known as panel data or longitudinal or cross-sectional time series data. And Y here is the dependent variable. All the x's are the all the x's are the independent variable. Y is the dependent variables. So I is for the entities, which can be country or states. It can be companies. It can be individuals. It can be families. And also it can be countries. So this is an example of the long form panel data. The long form panel data where in the first column, we have the entity, and the second column is year. The third column is Y, the dependent variables. Column 4, 5, and 6 are the variables known as the independent variables. So variables, when it is in the column, this is called a long form panel data. Okay, all the variables should be in column, then it's called a long form format. The wide form format, where we have the country in the first column, and column B until column L are all the years, and this is known as wide form data. The time is in column. From the wide form data, we have to convert into the long form data. So the first table is the wide form, and then we import into the long form using Stata. To analyze the panel data, we can use several software, not necessarily Stata. We can use Stata, we can use SAS, we can use Python, we can use R, we can use eViews. All right. I'm sure everyone here already learned a few of software for the analysis, statistical analysis. Can someone tell me what kind of what other software that you had learned? Can someone shout? All right. Ada tak? Belum ada. Can someone shout? You all you learn pakai apa for the data analysis? Can someone shout or tulis?
Yeah, some of us used MATLAB normally, Doctor.
Oh, you use MATLAB. All right.
Yeah, and sometimes we use Minitab or Python or many others.
All right. In our faculty, we use eViews, we use R, and also Stata. I have not experience using Python or MATLAB yet. All right. All right. This is an example of how we use data to reshape from wide to long. If you look at the first column, which is the ID is the entity. When we wanted to analyze, we have to convert from wide form to long form. Regardless of what software you use for panel data, we will use the long form when we do the analysis. Second column is year. If you refer to second column, for each of the ID, the year will start from 1995 and end year 2005. For ID number 2 as well, start year from 1995 until year 2005. So because it has entity, which is the ID, the first column, and it has the time period for second column, is called a panel data. And also for the country, in this case, the ID refer to each country. Country A, country B, country C. Country A maybe Malaysia, country B, Indonesia, country C, Singapore. And then the fourth column is the GDP. The dot means a missing data. A missing data for the GDP. All right. There are several selection methods of regression for the panel data. First, when we wanted to select using the OLS or fixed effect, we can use the Chow test. When we wanted to select whether to use fixed effect or random effect, we use Hausman test. And when we wanted to determine whether to use random effect or common effect or the PLS, we use the Lagrange multiplier, the LM. So from there, if we the first under Chow test, if we reject H null, means that we use fixed effect. For number 2, under Hosman test, if we reject H null, means that we select fixed effect instead of the random effect. And number 3, using the Lagrange multiplier, if we reject H null, means that we select the random effect. All right. All right. So far, that are all the basic about panel data. Okay. Any questions before we move to the financial equation model and also economic equation model? Tak ada? Alright. Kalau tak ada, I'm going to share with you the finance data and also the economics data. So all right, this is how we arrange the data in Excel. The A column, if you look at the A column here, the A column I want to write here, hold on, yeah. Oh, tak boleh write. Okay, the A column here are the years. If you look at the years from year 2008, 2009 until year 2016. Until year 2016. That is the time period for entity for the first company. For the first company, where the dependent variable is the earnings. The independent variable is the dummy return. Another one is the return, and then the regulation. The regulation under IFRS, financial reporting standard. So here, this data is collected to see whether the income or the profit of every companies depends on the return, depend on the positive or negative return, and depends whether the company using the international financial standard or not. Zero dummy means that they are not using the IFRS standard, International Financial Reporting Standard. One mean the company using the International Financial Reporting Standard when they come out with their report in the financial statement. So this is the accounting and finance equation model for using the panel data. So the B column is the entity. So this is how we list the company, and A column, this is how we list the years. So if you look at the year and the company, Y, year is the time period. B column is the company. Because we have several years, several companies, this is the second company. Acoustic is the third company. We have several years and several companies. Therefore, we call it a panel data. Panel data can be a balanced panel data or unbalanced panel data. In this example, we have all balanced data. I'll show you on the unbalanced panel data, sometimes because of the missing data or sometimes because of the establishment of the company itself, where it started late or it started earlier. Therefore, when we select the sample, we select all the available sample regardless of their establishment. So this is a balanced data. In order for us to identify whether to use fixed effect or random effect, you convert from Excel to Python or Minitab or R or eViews. You import the data from Excel to those software, and then we run using the Horstman test to identify whether to use fixed effects or random effects. So if we reject H null, means that we use fixed effects. So when you come out with the model, we use the fixed effects model. If we fail to reject H null, means that we use random effects model. But then after we fail to reject H null, we have to do either the Chow test or the Lagrange multiplier, or known also as Broch-Pagan, to identify whether to use random effects or the PLS. Under the second step, if we fail to reject H null, means that we use, in that case, we use the PLS. If we reject H null, means that we use the random effects. So any questions on the data, on this data class? Tak ada. Everyone familiar with panel data? Quiet means you you're familiar with the panel data. It's just that how we're going to do it in the financial model or economic model. But majority the students, they know how to use the panel data using the economic data. But because they are not familiar with the model in the financial model, so sometimes it's difficult for them to use the financial model for the panel data. Other than this, what we can do in the financial model, sometimes we wanted to, the dependent variable sometimes is the stock prices. We would like to measures whether the stock prices depends on several independent variables. So for example, okay, for example, in this case, for example, this is under A column. A column are all the companies and identified by numbers, identified by numbers, number 1, number 2, until the last data, until number 10. Investment, let's say investment is the stock prices. And value is, let's say, is the value of the firm. Value of the firm. And E column is the capital. The capital means that the capital, whether is debt or equity. So we would like to measure whether the investment of the company depends on the value of the firm or the capital of the firm. So C column is the Y, and D and E column is the X1 and X2. So here the financial model will be investment Y equals to beta 0 plus beta 1 value of the firm plus beta 3 the capital of the firm. So where to get all this information? Where to get all this information? Are you familiar how to get all this information from the website? Say yes if you know. Okay. I'm sure you know it, just that you doesn't want to say yes or no. Okay, let me share with you. Okay, let me share with you I want to share with you the website. Yeah, hold on. The website, so that we can come out, or so that we can collect the data from the financial statement. All right. Share content, screen, start broadcast. All right. If you look at, can you see my screen? If you type Google Finance, Google Finance, or another one is Morningstar. Morningstar. Google Finance, Yahoo Finance, Morningstar are the free available sources to get all the informations on the finance and also on the economic data. For example, Google Finance. Under Google Finance, let's say one of the company that part of my sample is Top Glove. For example, Top Glove. Okay, we have Top Glove here. What it gives us here is the stock price of Top Glove for 1 day, for 5 days, for 1 month, 6 months, and YTD is yield. Yeah, is the yield. This is 1 year. This is 5 years, and these are the maximum available, the data available for the share price. All right, this is the share price for Top Glove. Top Glove is a very good company to invest during COVID. Yeah, during COVID, the share price of Top Glove increased. If you look here, it increased and then is reduced tremendously after post-COVID. In order for us to get the data, the financial data of Top Glove, we go to financial. Under financial, we have income statement. We have income statement and then balance sheet, and the other one is the cash flow. If you familiar under the financial management, to measure the performance of the company, company, we can measure using all the ratios: liquidity ratio, profitability ratio, uh, asset asset turnover ratio, and also debt ratio. So there are 4 ratios that we normally look at when we wanted to measure the company performance. Here, under Google Finance, it gives us all the data from the financial statement. For example, total asset. This is total asset. Or total liabilities, total equities. Sorry, yeah. So the income statement data shows the profit of the company. It shows the profit start from the sales, the revenue, minus all the cost of goods sold, we get the gross profit. Minus all the expenses, we get net income before tax, before interest and tax. Minus interest, minus tax, then we get the net income or net profit. So when we in finance, when we analyze the performance of the company, the proxy we use either net income, net profit, net income, aka also known as net profit or net earnings. We can also use the ROA, return on asset, or we can also use return on equity as a proxy for the performance of the company. So if we in finance, if we wanted to measure the performance of the company, Y is the performance of the company, then the proxy will be net income, net earnings, return on asset, return on equity, or sometimes sales. And the independent variables can be normally based on the literature: total asset, total liability, cash. Those are the proxy normally used as the independent variables to measure the performance of the company. Here, what I show you in this Google Finance, we have here, we have all the financial data, company financial data. Let's say this is the Malaysian data. In Google Finance or Yahoo Finance or Morningstar, it has all the listed company available across the globe. Means that if you know that part of your sample are the Indonesian company, for example, here is Indonesia Energy Corporation Limited, for example. Okay, this is the Indonesian company. So from here, let's say Indonesia Energy Corporation is part of your sample and you wanted to measure the performance of the company, several companies, means that you would like to take the average, the performance of the listed company, of the Indonesia listed company at Indonesia, at Bursa Indonesia. So from here, you browse the income statement. This is the income statement. You browse on the balance sheet. If you click balance sheet, it gives you the annual data on the balance sheet and also the quarterly data of the balance sheet. In the balance sheet, what does it shows in the balance sheet? The balance sheet shows all the total asset and also total liabilities and equities. I just wondered, is everyone familiar with the financial statement for the balance sheet and income statement? Can you raise hand if you're familiar? Tak familiar ya? Alright. It's alright if you're not familiar. So just now when I give you an example of company performance, so under company performance, the financial equation will be, I write it here. The financial equation for company performance. Let's say we wanted to measure the company performance of the company, like net profit. Net profit of the company depends on the liability or total liabilities or total debt. Means that based on the theory, it says that higher debt level has a positive relationship with net profit, because high debt means high risk. High risk means that high income or high return. So let's say beta 1 is total liabilities, and then for x1, x2, let's say is the total asset. Okay. So I buang IFRS ni. So based on this financial equation model, we wanted to identify whether total liabilities and total asset has positive relationship with the net profit, because saya letak situ positive. If based on my literatures it says that negative, then I will put it negative here. Okay, but because the theory says that total asset has a positive relationship with net profit, and total liabilities also has a positive relationship with net profits, hence the sign there is positive. So based on this model, how are we going to collect data and analyze as a panel data? Okay. All right. If you look at this, data under Fin 5 worksheet, net income, the F column, net income is the Y, net income or net profit. So net income kena duduk dekat mana? Net income has to, di sini tak boleh ubah ya. Okay, net income should be at D column. At D column. So here insert row. We have to insert a column at D. D here will be the net income. Ataupun saya tulis di sini. So net income is read only. Hold on. I have to save actually. Spreadsheet. Oh, because I use this one. I use iPad. Jadi I tak boleh change anything here. Okay, J column will be the net income. Let's say is the net income. Therefore, net income will be the Y. So J, imagine J is the net income. So you have to copy and paste here. Copy Boleh tak boleh paste. Okay, and then you copy to J column. Next one, just now, total liabilities. Okay, total liabilities. The other one is total asset, total debt or total liabilities. So let's say we have another, let's say market capitalization is the total debt. Let's say is a total debt. So you copy to K column. And next one is total asset, G column, you copy to L column. So JKL, you have J is the net income, K is the total debt, and L is the total asset. So when you have 3 column, you can convert, or you can import it to other software to for you to analyze the panel data. So how can it call a panel data? It's called a panel data because of B column and C column. Look at B column. In B column, we have KLCC property, one company, and we have several years data for KLCC. We have net income for KLCC property from year 2005 until year 2017. And then we also have data for Axis company from year 2005 until 2017. Then the third company we have here is YTL Hospital. YTL Hospital data for net income, total debt, and also total asset. We have several years from year 2005 until 2017. From here, and because we have several entities and for several years, we call it a panel data. So for the model in finance, the model on the financial equation, we use several years data where we can get it from the Google Finance. In our university, we have data stream or econ database, EIKON, icon database, and that is also a good sources to get the finance data. All right. Any questions before we proceed further? Tak ada. Fitriani.
Yes.
Yes, Fitriani.
The data we have, if you want to use economic model like regression, that data panel regression, that is that we must fulfill from the data, so we can use the economic equation model. Maybe like multicollinearitas or heteroscedasticitas, or there is no assumption.
Again, can you repeat the question? Is it a question or is it a statement?
Oh no, question.
Is a question. All right. Can you repeat again the question?
The question is that what there is assumption from the
assumptions.
data.
Assumptions
Yes.
from the data. Okay.
Yeah, okay. That we must fulfill, or we use this model.
Correct. Correct. We have to make sure that all the assumptions are met. Then only we can do further on the panel data. If let's say like heteroscedasticity, all those things, we have to make sure that all the assumptions are met. Then only we use the Hausman test, and then we use the or the Chow test, another one Lagrange multiplier. The first step, if you look further, the first step, dalam first step dia selection method, Chow test, Hausman test, and LM. But before we come up with all these Chow test, Hausman, and LM, we have to make sure that all the assumptions are met. So kena buat dululah all the assumptions.
Oh, but so there is just heterogeneity, okay?
Yeah,
The
we have to make sure
assumption.
that all the heterogeneity are all none. Normally, for panel data, when we run either fixed effect, random effects, or OLS di sini, we use robust in Stata. We use the words robust to make sure that all those assumptions are met.
Oh, okay.
All right. Cluster robust error. Any other question?
No, thank you for the explanation.
You're welcome. So far, when you do the analysis based on your class assignment, what kind of model that you use? I mean, what kind of data that you collected? Any volunteers to answer? I just would like to know your experience with the data, so that after this we can do several exercise on how to collect the data. What model normally you use? What data normally you use? Stock exchange data, World Bank data. Very good. So stock exchange data. Hold on, let me check. Stock exchange data, World Bank, macroeconomic data, among others, right? When we look at the stock exchange data, okay, stock exchange data abroad. Stock exchange data, what are the data that you collected? Because once I know what kind of data you collected, I will show you other varieties of stock exchange data. Not only look at the stock prices, but other things, such as the bid-ask price, such as the return, trade volume, closing prices. Very good. Right. So volatility indices. All right. So you look at the stock market as a whole. As a whole means that you use the because normally you use the stock exchange prices, and then you compare and then you collect the economic data as well. Betul tak? For example, you akan buat closing ataupun closing price equals to ataupun you buat prices equals to inflation plus GDP. Look at the message, class. So normally this is what you collected from stock prices, correct? And because it involves several years and involve several stock market, then it's called panel data. So if you collect the prices for countries and also for 10 years, for example, prices every country or Asian countries for 10 years, inflation every countries for 10 years, GDP every countries for 10 years, then that is also known as a panel data. And then you can choose and then you look at the fixed effect or random effects using Hausman, and then from there you use the LM. All right, so if that is how you experience collecting the data, I would like to show you the data that is available based on the stock market. The stock market, when we stock market, for every stock market mean the closing stock prices for every company. Instead of you use the countries, use the company's closing price. Okay, let me show you. This is another example of financial data. We call it return. Return for the company. When you have a shares, you have a shares and you wanted to know whether your shares that you own has positive or has a return or not, then you will calculate today price minus yesterday price, and that is known as return. So return will be, okay, return will be, look at the message here, class. Return is return of the shares equals to today price, today closing price minus yesterday closing price. So that is how we calculate the return. So return equals to today closing price minus yesterday closing price. It depends on what? Based on the literature, it says that this return of the share, return of shares for every companies and every quarter, quarterly data. So here we have in the first row we have company, second row we have quarterly data. Quarterly data, quarter means we have quarter 1, quarter 2, quarter 3, quarter 4. So for example, if we have Excel, let me check ada tak data quarterly. These are all yearly. Oh, these are all yearly. Tak ada. Alright, instead of year, for example, this is year, what you can do, you change it, instead of year, you change to quarter. So we have, let's say I would like to measure whether company profit, whether the company profit affect the prices. So means that affect the return of the company. So here will be the profit of the company. I is quarter. Yeah, I is quarter. I is the company. T is quarter. And quarter, we can take quarterly data for several years. For example, we can take data for 10 years. So profit for 10 years every quarter, return for the companies every quarter for 10 years. And based on literature, it also says that return of the companies depends on the market capitalization or the size of the firm. Means that the bigger the firm, the higher is the return. A small firm has a small return because of the spread between today price and yesterday price. Because a share price for a large company normally expensive. Therefore, the spread or the difference today price and yesterday price is big. So based on the literature, it says that the market capitalization or the size, market capitalization is proxy for the size of the firm. The higher the market capitalization, higher the return of the company. So because we have several companies for several quarters, for 10 years, for example, therefore is also part of, is also known as the panel data. So that is for the financial equation data. Where to get all the stock prices? Stock prices, you can also get the stock prices from Google Finance, Yahoo Finance, or DataStream. Just now, when one of your friends says that you collect the closing prices, can you mention what kind of from which company or from which country? Is it yearly data or is it quarterly data? Can someone write it down? Yang tadi siapa tolong saya tu? Lokman. What kind of data? Can someone write when you experience collecting the closing price? What kind of closing price that you collected? Pernah experience tak? Previous close. Previous close. Alright, previous close. Is it country data? Company data? Closing price for certain companies? Or only one country? Is it only one country for several companies? Several countries. Company data, several countries. And that will be the dependent variables. Yeah, depend on the research. Yeah, correct. So it depends normally based on, if you look at all the panel data for the economic students, normally they would like to go very broad. They will look at the country data, countries data, companies, for each company's country data for several years. And then the independent variables will be the economic data. For example, macam ni lah. For example, like this. This is the economic equation data. Okay. Economic equation data. Y is the growth for countries, for every countries. Let's say Asian countries. T is time for 10 years. It can be 20 years, it can be 50 years. There are certain arguments for long-term data and short-term data, okay? And then beta 1 is expenditure, beta 2, X2 is the employment rate, and X3 is the income. So here we collect for countries data. Countries data for several years. Normally, this available for the economic data. But when you include, let's say, here, saya tukar ya. Instead of growth, you look at the stock prices. Stock prices. You look at the stock prices. The stock prices, you can choose stock prices for all companies listed at Bursa or you look at the average. Like you look at the average of the country stock prices. They call it in Malaysia we call it FTSE 100. FTSE mean Financial Times. Financial Times Stock Exchange, because Bursa Malaysia has in Bursa Malaysia, FTSE has several shares of percentage. They are the percentage of shares in our Bursa Malaysia. So we instead dulu 20 years ago, we maybe 15 to 20 years ago, the Bursa Malaysia prices, we call it KLIC, Kuala Lumpur Stock Exchange. But now, because of the shares from the international company, we change it to FTSE. Then what we do here, stock prices is the Y. Stock prices is the Y. Stock prices, you can choose all the countries, ataupun you only choose the companies and the countries. For example, stock prices for all the listed company in Indonesia for 10 years. And then you collect again you collect all listed company in Malaysia for 10 years. And then you collect all the listed companies in Singapore for 10 years. So your data, what your data will looks like is, for the Y variables, it will be companies, and then countries, and then year. And normally if we have many data like that, we call it a dynamic data, dynamic panel data. And then you have the X1 is the GDP, X2 is the inflation for that countries for 10 years, and then X3 you have unemployment rate for that country for several years. Okay, so that is part of the economic equation model. Okay, any question, class, before I proceed? FTSE. Yes, FTSE is FTSE. In Malaysia, kalau you tengok, I'm not sure, but Indonesia, maybe you can share with me. So here, Bursa Malaysia, FBM and KLCI. Even though we call it Bursa, but we call it FBM. F meant for FTSE. FTSE. So we have FBM 70, FBM 70. What does it mean by FBM 70? Means that the top 70 companies, where the Bursa will calculate the average closing price for 70 companies, the top 70 companies. If FTSE 50 means that the top 50 companies. FTSE 100 means that we calculate the data for 100 top companies. If FBM emas means that for all listed companies available, then we calculate the return, the closing price, and the FTSE ataupun FBM emas. So this in order for us to collect the data for closing price, Bursa Malaysia has a very limited data they share with the public. So for closing price, stock prices, if you can't get it from Yahoo Finance or Google Finance or Morningstar, you can try data stream. You can try this data stream or Econ database. Econ database is part of the data stream. Okay. All right. Any question? Class, can you understand me? Can you understand? So far, so good. All right, any question before we proceed? Tak ada. All right. Okay. I'll share with you the available data. All right, regulation. For example, in Malaysia, I choose Malaysia data because I'm familiar with the Malaysia data, right? In year 2013, Bank Negara Malaysia or Central Bank has changed the regulation for all the financial institution in Malaysia. They changed it. The regulation changed in year 2013. There are several changes made by central bank, such as on the capital adequacy ratio. Capital adequacy ratio, CAR, the CAR. When we talk about the banks or financial institution, the financial institution can be all the banks, can be all the cooperation or koperasi. It can be all the insurance company. It can be all the securities company, because securities company also collect fund from the customer. All the companies that collect fund from the customer or deposit from the customer, they have to be registered with Central Bank of Malaysia. So Central Bank of Malaysia would like to see that the capital base for all the financial institution in Malaysia become huge and strong. Therefore, they changed the IFSA and also FSA. Financial under IFSA ataupun IFSA means Islamic, Islamic financial institution in Malaysia. FSA is meant for all the conventional financial institution in Malaysia. It based on they have to change their capital adequacy ratio, the CAR. The CAR, when we calculate the CAR, capital adequacy ratio, we calculate based on their asset and the liabilities. Financial institution, when they have too much liabilities, they have a very high risk of bankruptcy. So the central banks would like to reduce the capital adequacy ratio for each of the banks. So if we would like to see whether the new regulation, which is introduced in year 2013, is effective or not, that regulation can be part of the independent variables. So when we look at the financial equation model, okay, di sini I'll change it to regulation, and here I change it to profit of the firm, and then the size of the company. The main if you look at the model, and the model profit equals to beta 0 plus beta 1 regulation plus beta 2 market capitalization. the literature says that market capitalization is a proxy for size of the company. Here, we would like to measure whether the new regulation imposed by Central Bank of Malaysia has effective or not to all the financial institutions in Malaysia. It measures the effectiveness measured using the profit. If the CAR is effective or the new regulation imposed is effective, means that the performance of the company is good, means the performance of the company increase, and it's proxy by the profit of the firm. Profit means net profit, net income, net earnings. This regulation imposed in year 2013, so we can collect data for all the financial institution listed or registered with Central Bank of Malaysia, and the regulation will be a dummy variables. The effectiveness of the new regulation imposed by the central bank can be measured using the dummy variables, because the regulation is 0 before the new regulation imposed, which is pre, and 1 after the new regulation imposed, which is 1 lah. 1 is after the new regulation imposed, 0 is pre or before the new regulation imposed. So here, under the financial equation model, where to get the profit of the financial institution or the banks? In Malaysia, we have Islamic bank and conventional bank. We have local banks, and we also have foreign banks. We can choose profit for all the financial institution registered with Bank Negara Malaysia or Central Bank of Malaysia. Or you can choose only Islamic bank and conventional bank, only the local banks. But for the regulation, there is no data on the regulation. There is no numbers on the regulation, data in numbers on the regulation. But what we can do on the regulation, we put dummy, the new regulation imposed, pre and post. Dummy 0 before the regulation imposed, 1 after the regulation imposed. Market capitalization is the size of the firm. We measure market capitalization equals to the stock prices times the capital of the company. That is market capitalization. Market capitalization, according to the literature, is measure the size of the company. So the higher the bigger the firm or the bigger the banks, the higher the profit. And regulation also, based on the literature, it says that every regulation imposed by the government, or in this case the Central Bank of Malaysia, is actually one to make sure that all the financial institutions are stable, and also to increase the performance of the company. So we say that post impose of the regulation, profit of the firm increase. Before the regulation imposed, profit of the firm is lower. So that is based on the literature on how we come out with the financial equation model for the banking sector or for the financial institutions. All right. Let me check whether we have question or not. Tak ada. Can you understand me about the regulation, the financial equation models on the regulation? And it's also, when we collect this data, is also a panel data. Kenapa? Why is it panel data? because we have several banks. In Malaysia, we have Maybank, CIMB Bank, RHB Bank, that is for local, BSN Bank. And then we have also Islamic Bank, Maybank Islamic, CIMB Islamic, RHB Islamic, BSN Islamic. So Islamic Bank, conventional bank. We also have foreign bank like HSBC, ABN AMRO, Bank of China, Bangkok Bank. Those are the foreign banks. So when we include all the banks as part of our sample, and we have several banks, and then we have several years of data, which is before regulation, after regulation. Then we have, meaning that we have several entity and several time period. Therefore, is known as panel data. All right. So if we look at Excel, under FIN4, but here we don't have the this is on the equity IFRS for the listed company, not on the financial institutions. Half an hour ago, we talked about IFRS. IFRS is a regulation of financial reporting method, financial reporting method. So it's part of the regulation juga. It's part of the regulation. So instead of IFRS, we change to the IFSA. I meant for international financial reporting atau international financial for the banking sectors. So that is measures the regulation. So when you look at the financial data, not necessarily you collect all the economic data. You can also collect the company specific data. What does it mean by company specific data? Company specific data is like the financial statement data, all the items in the income statement. For example, net income, size of the firm from capital, from market capitalization, or sometimes people use total asset proxy for size of the firm. The bigger the firm, the higher performance of the company. Smaller the firm, means that the company will have low performance. So that is based on the literature. So company specific data. What does it mean by company specific data? All the items or all the info in the income statement, all the info in the balance sheet, or the cash flow. Those are what we meant by specific, company specific data. Okay. Any questions on finance data? Your experience when you do research so far, do you have any problems collecting finance data? Ada tak? Data cleaning. All right. So yes, data cleaning. For example, this one. Oh, tadi dekat sini. Here. Look at here. Nampak tak kosong kat sini? Can you see? There is empty data for return on asset, dividend yield, and net income. So what should we do with this row, number 15? Normally, what do you do? You omit, you erase. Yes, you can erase. But there are, I dulu pun erase juga. Yeah, I also erase the data. But there are data. If your data is small, let's say you only have 50 data, 100 data. If you omit all, if you erase all those data, your sample number will be small. So what you can do based on literature, you have to find the literature. The literature use mean or median. They use median. For example, net income. For net income, this is axis, isn't it? Axis. Net income data is missing. So find the median for net income for axis. Then you add that median here. Di sini. For dividend yield also missing. What you have to do, find axis, median for dividend yield. Right? Data cleaning is quite messy, and it takes a very long time to clean the data. So you have no I think here you have no excuse. We have to actually, we really have to clean the data to make sure that the data is efficient data, so that we can at the end, when we do analysis, we can get a very good result which represent the whole sample or population. So in terms of erase the missing data, yes, you can do it if you have few thousand data or few hundred data. If your data is very small, it's not advisable to delete the data. What you can do, you letak median or mean. Normally people letak mean. All right. So any other question? Share your experience, how you collect data on finance data or economics data. I'm sure everyone quite familiar with the economics data, but not on the finance data or finance model. If you have any questions on finance data, I'm willing to share with you. For time series data, boleh guna interpolation ya Prof. Yes, if you have literature that support your interpolation for that particular data, then you can use. But based on my experience, I come across a literature use mean and median. Okay. All right. Lagi? Any question? Kalau tak ada, ada lagi? We look at the economic data. Economic data, because you're quite familiar with the economic data, if you see, if you can, based on this economic equation is very straightforward for panel data. Yeah. GDP, export, import. In this case, economic equation data, we have the GDP depends on the export of goods and services of the country. It depends on the import of goods of the country, and the employment rate. Sometimes you can use employment rate if you have good literature, or unemployment rate. Very straightforward for several countries for several years. If you look at the data for economic data will looks like this. This is, for example, province ini using the Vietnamese country, Vietnam country province or the district. The GDP depends on the import, export, and employment rate for certain district. So district, this is the first district. This is the second district. Kalau in Indonesia, what do you call district? In Malaysia, we call daerah. In Indonesia, you call it kabupaten. Betul? Provinsi. Oh, provinsi. So we call it district is kabupaten is the same with provinsi or not? Kota Maya. Sama ya? Right. In Malaysia, we call it daerah. Only one name for district, which is daerah. So for example, provinsi higher level than kabupaten. I see. I see. Then district lah. In Malaysia we call it district. Yeah, the province. So here province, we have several province from one country only. From one country, Vietnam. But we have one district, second district, third district. Here data dia banyak. Data dia until 400 over. Yeah, has several districts. So from that district, for several years, district is the entity, years is the time. Therefore, we have panel data here. Okay, panel data. So these are all the balanced panel data. We have also unbalanced panel data. Let me check. Di sini semua balanced panel data. Here, this is unbalanced panel data. If you look at the company and year, for example, Affin Bank. Affin Bank data, Affin Bank data started 1999 until year 2013. Affin Islamic from year 2006 until 2013. Why is that so? Because Affin Bank established earlier than Islamic Affin. Affin Islamic established in year 2006. Affin Bank established year 1999. So that's why we have unbalanced data. So the data availability depends on the year establishment of the company, in this case of the bank. For Al-Rajhi Bank is the foreign bank, Islamic foreign bank in Malaysia. It first come to Malaysia, registered with Central Bank Malaysia in year 2006. And then we have Al-Khair International Islamic Bank from year 2010 until year 2013. Lepas tu dia ada tak? Lepas tu maybe they already closed their operation in Malaysia, and sometimes the data only available for very short period because they move out from Malaysia. They close their bank in Malaysia. Allianz Bank from year 1999 up to year 2013, but Allianz Islamic Bank from year 2007 until year 2013. So the availability of the data, yeah, when we collect data, it depends on the availability of the data. And in this case, due to the year establishment of the bank is not the same, then this panel data is called unbalanced panel data. Is everyone familiar on how to run the data? Run data, you use MATLAB, because you use MATLAB, and then you also use Python. So the way you run, you can use, yes, you can also use R, you can use Stata as well, right? the best for Stata, because I'm familiar with Stata, the Princeton. Pernah dengar Princeton? The online Stata tutorial, which is free, the online, yeah, all the available economic statistical summary are in princeton.edu. It has all the recently they add the R. Dulu hanya ada untuk Stata. So if you want to learn Stata independently, you can try look at this website, princeton.edu. University Princeton. Stata University means you ask about which university? Princeton University. Dulu when I learned the Stata, I learned it independently. I use this website lots. Tapi sekarang there are numbers of YouTube, free online courses. You can try to seek for Stata for R. All right. Okay. So this is economic equation. We done on the financial equation. We done on the selection method and type of panel data. So I think you can ask question now before we have another 20 minutes. If you want to share anything with me on the or you wanted to know further on the financial data. My background is finance, so I'm more familiar with finance data. But in Malaysia, we also have readily available economics data from EPU, Economic Planning Unit, EPU. Or as your friend mentioned here, you can also get it from World Bank. World Bank data is yes, Lukman.
Assalamualaikum warahmatullahi wabarakatuh, Prof. How are you today?
I'm good, thank you.
I want to thank you, first of all, for the very informative presentation. Panel data can be tricky, but you make it look very easy. Let me say so. Yeah, my question is that a lot of the quantitative data that is, as you said, available through DataStream or Icon Refinitiv, and many universities in Indonesia also are obtaining access to these data sets. But we see at least people nowadays, they use, some people use hand-collected data from financial reports. For example, one of my students, I sometimes supervise students. One of my students wants to talk about the impact of cybersecurity on firm value, for example, as a research topic. And this is not data that is available, I think, in any index or something. So what he did was look at the financial reports and see if they reported capex in cybersecurity. I was wondering if you have experience with similar types of data collection where you have to manually get it from the financial reports instead of relying on readily available sources like Refinitiv or DataStream. Thank you, Prof.
All right. Thank you, Lukman. Yes, my PhD, which I did years ago, is a hand collected data where I collect it from website, Bursa Malaysia website. For example, in Bursa Malaysia, they have announcement. So every announcement here, yeah, what I look at what we call the profit warnings. The profit warnings data can be positive profit warnings. It can be negative profit warnings. Means that when the company forecasts their profit, it can be the forecast can be better than before, or it can be worse than before. So every profit warnings that the company forecasts and is available through the website, I hand collected it. I pick it up one by one. So I choose for that time for about 5 years profit warnings. All the listed company that available at that time is 800 over. 800 over is hand collected using the key words. Keywords is profit warnings or profit or earnings warnings or warnings. As long as it's related to profit, I hand collected it. So I have to read all the announcement for 5 years. At that time, not so many announcement because it's compulsory, but few of the companies they don't do forecast. It's not compulsory at that time, but now every companies are compulsory to do the forecast and make it available through their website or through Bursa Malaysia. So it's hand-picked data. Hand-picked data is tedious, but not so many data available. So out of 800 over companies for 5 years, profit warnings is only around 100 over. Therefore, I increased the numbers of years. I managed to get around 300 profit warnings. So it depends whether it's positive profit warnings or negative profit warnings. The same goes to forecast of stock prices. Forecast of stock prices also handpicked. Certain companies, they do forecast, or the financial analysts do forecast the stock prices for the big corporation, big companies, and it's also handpicked. If the forecast is negative, then we say that it bad profit warnings. So if it is good, is a positive, means that profit warnings is positive, means that the profit warnings is a good one. So profit warnings can be in numbers, or it can be in dummy variable 0, 1. If it is positive, 1. If it is negative, 0. Because it involves several companies and several years, then it's called is a longitudinal data, then it is a panel data. Just that is not balanced, is a unbalanced panel data. So that is profit warnings is the is the dependent variables. So profit warning depends on what? Depends on the size of the company, depends on the sales of the company, depends on the other firm characteristic, for example total asset, ataupun depends on the auditors, whether they have the top 5 auditors or not, or also depends on the type of shareholders. If the shares of the company, majority of the shares owned by the institutional shareholders, they will have less profit warnings. So based on that, it's all handpicked. Numbers of shareholders also handpicked. Profit warnings also handpicked. Auditors, who are the auditors, also handpicked. So it's very tedious. But it's you will self-satisfied with the data because it's handpicked. So I hope that answer your question. Any other question, class? You can ask how to collect finance data, economic data that you would like to do your thesis, or perhaps you would like to do for your PhD. Any question? Jangan malu-malu. Alright, those those are the handpicked data. If you look at this example, it's not only profit warnings, it's not only a number of shareholders, it's not only the type of regulation, the type of financial reporting they use, but also the dividend, forecast of dividend. The dividend reinvestment, certain company, the dividend, the company did not pay dividend, they reinvest into the company. Okay, so those are the data that are handpicked. Certain companies, they change auditors. Change auditors is the independent variables. Performance is the dependent variables. If the company change auditors, meaning they have something hanky-panky in the company. They change auditors. Normally, auditors doesn't want to continue their services with that company because the company doesn't want to listen to them. So auditors doesn't want to take the responsibility, so they quit. So the company has to change auditors. Change auditors is also shown that the company has a problem inside the management. So the management might have some problems. Therefore, they change the auditors because auditors doesn't want to listen to them, and that will have impact on the company performance. Normally, when the company change, the CEO change the auditors, which are all the handpicked data, which is quite tedious, will affect the company performance. So Y is the company performance, X is the main X1 is the auditors, change in auditors. Data for the change in auditors is a dummy variable. 0, the auditors remain in the company. 1, for that particular period, the company changed the auditors. You can collect data, quarterly data, for several years because I think across the globe, all the companies now have to come out with the quarterly financial statement. So all the quarterly financial statement is readily available from the company website or from the bursa itself. Do you understand me, class? Faham tak? I assume faham, eh? Oh, another one is about trading halt. Trading halt. Trading halt is trading halts are the suspension given by bursa, in our case Bursa Malaysia, when the prices of the share increase more than 10% or decrease more than 10%. Then if that happen, the company trading will be stopped by the Bursa Malaysia, and they will issue a letter answered by the company why the share price suddenly increased by certain percentage and decreased by certain percentage. That is that is also handpicked information. How to develop good research question topic based on available data. Research question comes from the problem statement. Every research, when we wanted to do research, is all from the problem statement. Problem statement, when we develop the problem statement is actually like a heart of every research. Maksudnya jantung lah. Macam for human, tanpa heart you cannot survive. Sama juga same goes to the research. If you cannot develop a good problem statement, then your research is not a good research, because from problem statement, from background, we develop the problem statement. That problem statement will develop the research question. For example, like IFRS, or like international, the IFSA. IFSA is Islamic, I tak ingat Islamic financial, IFSA, Islamic financial standard, FSA, financial standard for all the financial institution in Malaysia. If I want the objective of the government impose a new regulation, one is to make sure that the financial institution in Malaysia can survive, they have a good return, and also they can protect all the customer. Yeah, protect all the customer, because if the capital adequacy ratio, if the debt of the financial institution is too high, the chances for them not able to pay the deposit to the customer is high as well. Therefore, the government, the Central Bank of Malaysia, come out with a new regulation to reduce the capital adequacy ratio, to reduce the liability of the financial institution. That the Central Bank of Malaysia imposed the regulation so that each of the financial institution can survive and get a good performance. They can show a good performance, so that every customer, every investors will have a confidence towards the financial institution. The objective of the research, when we look at the regulation, we will measure the effectiveness of the regulation. So that is the problem statement. Problem statement, what is the problem statement? Problem statement is the changes. The changes from the old regulation to the new regulation, because the government, the Central Bank of Malaysia would like to see would like to maintain the performance of the financial institution in Malaysia. Therefore, as a researcher, we would like to see whether that regulation is effective or not. If it is effective, then the performance of the company or the financial institution will increase. The deposit from the customer also increase. The share price of the financial institution also increase. So that is how we measure the effectiveness. One of it, one through the performance, through the profit, through the sales, through the deposit. So the problem is the problem is the financial institution has high debt or high liquidity. Therefore, it will affect the performance. It will affect the confidence level of the customer and also the investors. So from there, we develop the research question. The main research question is the regulation imposed by the Central Bank of Malaysia is effective? If it is effective, then it will be shown in the stock price of the financial institution, if they are listed. The net income, the liabilities or total debt will reduce. The deposit by the customer will increase. So how actually you can develop those good research question? It based on the problem statement. I hope that answer your question. Yeah, sometimes we choose the data first and then we develop the problem statement. If this is the case, then you really have to read lots on the topic. But if But if it's not available, kalau data tak available, then you have to make sure that, if the data is not available, then you have to make sure that your data that you going to collect is available elsewhere. Contoh contoh yang tak available, data tak available di Malaysia, data in listed company in Malaysia, foreign listed company in Malaysia, they can be listed in Malaysia and also they also listed overseas. So sometimes a listed company overseas, they have better return than the local listing, because local listing, it depends on the liquidity of the shares itself. Liquidity means that the transfer of buy and sell the shares is very intense, then liquidity is good. Then return is good for the shareholders. But normally on the developed country, the liquidity is high. In Malaysia, liquidity is a bit low. All right. Hope that answer your question. Any other question on the finance model, finance equation model? How we can use the panel data in finance? Tak ada. Alright. Let me check. Apa lagi yang tinggal? I rasa tak ada. I think siapa jadi the host? Who's the host? Ning. Ning?
Yeah, Doctor.
Yeah, Ning.
Sorry, I need to turn off my camera because of the signal is not good here.
Alright, Ning.
Yeah.
I think I'm done with the
Yeah.
presentation.
Doctor,
Yes.
maybe I want to ask a question to you.
Yes. Yes, Ning.
Is it okay if I ask question?
Yeah.
I want to ask
Sure.
about, what are the key differences between fixed effect and random effects models in panel data analysis? And then how do these differences impact the estimation results?
If you look at the fixed effects, the fixed effect says that here, clearly says that here,
Yeah.
it depends on the beta zero. The beta zero,
Okay.
the beta zero is here, including dummy beta. It depends on the beta, the difference in the beta zero between fixed effect and random effects is somewhere here.
Right.
Yeah. Kat mana tadi? Ada dalam salah satu one of this one. Because fixed effect, the beta zero is fixed, and random is not.
Oh, okay.
So that is the main difference. Sekejap saya tengok di sini.
If I could maybe elaborate.
Fixed. Here. Yes. About bias. Go on.
No, you first, Doctor. Sorry.
So fixed effect models, yeah. Under fixed effect models, they don't change. The variables that don't change over time, or that change over time for all the entities. Entities here is the individuals, or companies, or countries.
Okay.
Yes. Just now, someone would like to add.
Yes, Doctor. Sorry.
Yeah.
I think if I may elaborate, Dr. Ning's question, sometimes we have trouble differentiating which kind of data or which kind of research question is better suited for fixed effects and which one is better suited for random effects. At the end of the day, can people just do Chow, Hausman, and Lagrange and let the statistics decide? But in when we do proper research, that's more of a formality. Like we should we should already have a good understanding of our research question, the data we use, and whether that's more appropriate using fixed or random effects. Sometimes it's not clear, but are there any indicators to know whether this is the type of data for fixed effects model and this kind of data or research question is better suited for random effects?
Yes, correct. Like slide 13 it says that each cross-sectional units for fixed effect has its own intercept. So like my data, because it involve regulations, it involve ownership structure. The data is actually does change according to the time. So time has plays a role in my data, because the data that hand collected based on the ownership structure, based on the different auditors, different regulations, then it has a time effect in my case. But as Lukman mentioned just now, there are several data that you clearly can identify that time does not affect the Y. Therefore, it's clear cut that you can use based on the fixed effects. Because random effects, it says that intercept for each cross-sectional unit is drawn from a distribution that is centered around a main intercept. That is the main difference between fixed effect and random effects. I don't have the graph this evening, but if you look further in the slide that given to everyone earlier, it shows the graph between fixed effect and random effects in a graph.
Yeah. Thank you, Doctor.
You're welcome.
Okay. Maybe is there any question from another audience? From another participant? Do you have any question? Or you want to say something? Okay, I don't think they want to say something.
Alright.
Yeah, it's already 11 o'clock here. I think, yeah.
Alright.
We need to finish.
Okay. Let me say something before we end the session. Thank you, everyone. Thank you for listening to my presentation for 2 hours. I hope you can have a good. You will have a good research question, research problem statement for your master and maybe for your PhD later.
Thank you very much, Dr. Balkis Haris. And now I want to remind all participants to fill the attendance list. The link is already given on the chat box, so you can fill it properly. And let us take picture together. So I want to invite you to open your video on. And then we can take picture together with Dr. Haris.
Can you see 1, 2, 3 so that everyone can get ready?
I think they are still preparing the video. Okay. Maybe because of my connection also. What about the screen of operator? Is it full enough from all participants?
Not yet, Buning.
Oh, not yet. Okay. Still waiting.
But yeah, I think that's all.
Okay,
Take a picture.
I see happy face from all participants. Hopefully, you also happy to hear the information from Dr. Haris. And maybe you can come to UITM one day.
Yeah, all are welcome to UITM. We are based in Shah Alam and also in Puncak Alam. I also would like to visit Institute Teknologi Bandung as well. I will inform everyone if I go there.
Yeah.
Okay, we'll take two picture. Stay still, everyone. 1, 2, 3. One again. 1, 2, 3. Okay, thank you.
All right. Thank you, everyone.
Okay, thank
Bye.
you.
Thank you,
Okay.
Doctor.
Thank you, Doctor.
You're welcome.